Welcome to Kentucky Horsepower, the official podcast of the Kentucky Automobile Dealers Association.
Hi and hello, everyone. This is Jason Wilson with another edition of Kentucky Horsepower, the official podcast of KADA. And very excited to have with us today from Bernstein Wealth Management, Todd Buechs, who's a senior investment strategist. Todd, thanks for joining us. How are you doing today?
I'm doing fantastic. It's almost
Good.
a holiday.
That's right. That's right. It's hard to believe we are kind of getting to the end of the year here. Christmas here coming up very shortly, and then the new year. And that's sort of what prompted this conversation. KADA works with Bernstein on our KADA investments portfolio and strategies and whatnot. And they've proven to be a really great wealth of information for us as we go through the year and plans moving forward. And in fact, Todd and I spoke last week, just sort of the state of things, and got to thinking, this might be great information to share with our members. Certainly, they would find it interesting as we, again, wind down 24, head into 25. So, Todd, with that, let's talk. We've had a few things going on over the last month or so, right? We had a presidential election, sort of trying to predict the future as far as what that looks like and understanding what that means, that we have a new administration coming in, how that drives financial policy, what sort of impacts that has on the various markets. The nice thing is we had a presidential election that was decisive in that we know what's happening. We know that we do have President-elect Trump coming back. So whether you were excited about that, not excited about that, we at least have clarity on what's going on. So with that, Todd, let's just sort of get into it a little bit here. Based on the current administration policies and things that are in place and how that has impacted the markets, inflation, all the things we've heard about over this last election year, and now moving forward to a new administration and then thus a new direction. What do you see from where you're sitting? And I know you talk to a lot of clients that have concerns and whatnot. So let me turn it over to you and share some thoughts of what you're seeing out there and kind of the message you're sharing with your folks.
Sure. So maybe we'll break it down by interest rates, inflation, and then go into markets. We've been making great progress on inflation, but kind of over the last 4 or 5 months, we've hit a plateau. We haven't made much progress. And we know that the Federal Open Market Committee, has a dual mandate. One is to maintain purchasing power. That's to keep inflation in check at that 2% level. And the other is full employment. I would argue that although some of the jobs data is slowing and it's not as rosy as it was, we are still near full employment. That means we've got to worry about purchasing power or inflation. So if there are expectations that the Fed is going to cut down to what they'll call their neutral rate, where Fed overnight rate is neither supportive of growth nor detrimental to growth, I think we need to temper those expectations in the new year. Okay. Now, lower interest rates are good for bonds and they're good for stocks. Lower interest rates are good for loans and loan rates. If you're in the car industry, you know that's a good thing if rates go down. They're good if you're in real estate. There's a lot of reasons why the president-elect has been pretty vocal, both in his first time in office and now, about wanting lower rates.
Sure.
However, when you've got that mandate to maintain purchasing power or keep inflation in check, what you don't want to do is have to reverse course.
Okay.
We think that the Fed will cut on the 18th, so next week, because of what we've seen, the data points we've got. But then we think they're going to pause. They're going to have to look to see what are the new reports. What's inflation doing? Where's employment? And then they're going to have to really see what President-elect is going to do. He's made lots of campaign promises.
Yes.
And we can get into that. Okay. And many of those at face value could look as inflationary. So that would go against what the FOMC is trying to accomplish. But as I've told many clients, he's not in office yet. He does have the ability to enter into and exit treaties, and he has the ability to levy tariffs. But we know that the president-elect sees himself as a really strong negotiator. And I think where we're winding up is that let's wait and see what was said on the campaign trail and what is done.
Sure.
I mean, tariffs are like a tax. They are inflationary, especially if there's retaliation from the other side. But I'd say, look, I think our firm believes that this is negotiating. He's already gotten both Canada and Mexico to have separate calls. We know that Europe is already talking about buying more liquid natural gas and adding liquid natural gas terminals. So it seems like it's been a little bit successful. It's not even in office yet. So I don't know that it's going to be a blanket tariff to the levels that he spoke. I mean, at one point he said 60% on China. I think maybe 10% more likely. Right. And we've already had, to be fair, we've already had China come back and say they're going to limit our precious metals, which if you're in the car industry, you know that especially with EVs, you need a lot of those precious metals for batteries, et cetera. So, it remains to be seen what will be done, what's negotiating, and what the retaliation could be from those other economies. What we do know, though, is that the U.S. will be much less impacted by tariffs than other countries because we are we're a net importer rather than an exporter.
Okay. So, that is a great point. And again, I think what you're saying, Todd, if I'm reading this right, is all the, if we see these hysterical reports or whether it be various legislators or talking heads saying it's going to be end of days with tariffs and everything else, we are so early on in this process. This is, and many of our audience who are car dealers understand negotiation, and this is but a very first step discussion to just sort of get things moving forward and on the table. That's kind of it? Yeah.
I think that's fair. He wants to give himself some room. Mm-hmm. He wants those trading partners to understand that he's serious and that look how bad it could be. But global economy, we all depend on each other. Us less so because we're a net importer, but others because they're net exporters. The first time around when he raised tariffs on China, we saw a huge shift away from China to Vietnam, to India, to Mexico, and to Canada. Right. So Mexico and Canada have become huge trading partners. The growth rate was pretty phenomenal as companies switched from sourcing goods from China to those two countries. Now, for the auto industry, that's pretty significant because a lot of OEMs source parts from those two countries. Right. There's a lot of vehicles that are brought in. I mean, you could think about, if he's trying to negotiate, he could take the chicken tax route, which means he's going to tax trucks coming into the United States, which, a lot of the truck manufacturing is really weighted to the U.S., but there are, Toyota has 55% of their trucks being brought into the United States from outside, thinking, Mexico. So it remains to be seen which would be the winners and losers in that. Right. But again, I think we have to take, a tempered view of that because we just don't know what's going to happen first. I mean, not that he's let it impact him before, but you don't want to make enemies in your first day of taking office because there's a lot of other things that are going on in addition to trade and tariffs, including what's going on in the Middle East, what's going on in Ukraine, et cetera. Right.
No, all good points. One of the things we spoke about last week that I thought would be interesting to share with our folks today is if you're an avid Trump supporter, why you shouldn't be overly excited, and if you are devastated that Trump won the election, why you shouldn't be so down. And I think history kind of points to various things. But Todd, if you could touch on that a little bit, just to again bring some consistency and just sort of a more measured approach versus what we may hear on various talk shows, news, et cetera. I think that'd be beneficial for our folks.
Sure. I think we'll all agree that promises made on the campaign trail are seldom delivered on, at least in full. So if I've got someone who's distraught over the election results or someone who's ecstatic over the election results, I try to remind them, number one, he's still not in office. That's another, little over a month. Number two, he can do two things: enter into and exit treaties or levy tariffs. After that, he's going to need support of Congress. Now, we know red wave. We saw that there's now a majority for the Republicans in the Senate, but it's not a supermajority, which means there's still filibuster. We know that, look, the Republican Party is still fragmented. We have some fundamentalist Christian portion of it. There's different factions that may or may not be aligned with the president-elect. Matter of fact, there were some Republicans who were pretty vocal against re-electing President Trump. Therefore, he's going to need some cooperation. Some of that may need to be bipartisan.
Sure.
It's not a supermajority in the House either. I mean, I live in the great state of California, or the great taxation state of California. And, we're seeing elections being flipped 20 plus days after the election from red to blue. Therefore, you're going to need some cooperation. That's the big thing. The second point I'd make is that, look, if he doesn't bring down prices, which when either candidate was promising to bring down prices, we were struggling to figure out how you do that, because, just to remind everyone, inflation is just the rate of change of a price from one period to the next. If you want to bring prices down, you need deflation. So, we saw goods prices, during the pandemic go up almost 20%. Why? Because everyone was stuck at home and they wanted to buy a new sofa or put in a pool or, do home improvement projects, and the demand went up for all of those materials. It was tough to ship because of quarantine, because of COVID, what was going on in China, et cetera. But once you satisfied that demand, things were fine. But prices didn't come back down dramatically on goods. Inflation rate, the rate of increase in prices has slowed, but still, we're still seeing inflation in the system, which means prices haven't come down. So if someone's ready to find want to take a long walk off a short pier because of the results, I remind them that there are midterm elections at the 2-year point. And whatever majority that's in the Senate and in the House of Representatives could go away if prices don't go down. And I think that's a tall task. Energy prices have come in, so that's an input cost. So that I would think that would lend itself to lower prices. But, I can't remember the last time a lot of industry decided, hey, look, we've raised prices, let's lower them because our input costs have gone down. So it remains to be seen how successful he'll be in delivering that campaign promise, which seemed to be a lot of the impetus behind a lot of blue voters becoming red voters.
No, look, all of that makes sense. And I guess my next question would be, as you are a strategist, so you are looking at all the, of course, fundamentals of the economy. You're looking at the day-to-day ebbs and flows, changes, that thing. As you take a more macro look at 2025 as a whole, is there anything specific that you're going to be hyper focused on, or you would advise folks to keep an eye on as far as making good decisions on their own, as it relates to their own pocketbooks and things of that nature?
Well, as we started out talking about interest rates and inflation, interest rates, there's a big relationship between interest rates and where the level of interest rates are and what markets do. If you think about the extremely low period that we had of interest rates that we had kind of leading up to the normalization of rates in 22 and 23, if I'm getting 1% from a treasury bond, that's not very attractive. That incentivizes me to go into riskier markets. I would hazard a guess that most of the people listening on the podcast have seen their home prices rise. Why? That's a risk asset. People have bid those things up because interest rates were low, borrowing costs were low. So I would be watching the absolute level of interest rates, what the Fed is saying, where the 10-year is. The 10-year is a determinant of kind of 30-year mortgages. And 30-year mortgages, if we think about it, the largest asset that most people in the United States own, it's their home. That will do a lot or go a long way to consumer behavior, how I feel. Is my house going up in value? Is it going down in value? Are my borrowing costs easier? Can I carry a balance on my credit card? And will it be difficult then to service that debt? So I would watch interest rates and inflation data and listen to what the Fed says. I look at equities. They've done quite well, better than we ever expected over the last couple of years, although very difficult year in 2022 when the Fed communicated a lot less interest rate normalization and then kind of went right past the exit and kept going. We look at pretty full multiples on equities. If you're thinking about especially large cap stocks in the US, technology's gotten more expensive, but you also get growth there.
Right.
More than likely, the results next year are going to be driven by earnings growth. Okay. As long as you can grow earnings, that's fine. I don't expect as much from multiple expansion. And what I mean by that is if I'm paying $20 per dollar's worth of earning on a stock and nothing changes, same earnings year to year, but now I'm paying $25, that's multiple expansion. I'm paying more per dollar's worth of earning. I don't think we'll see as much multiple expansion. We saw some of that this year, especially in the technology stocks. With bonds, if rates are flattish, I'm okay. Why? Sure. Because we're getting more yield than we've gotten from both taxable municipal bonds, than we've seen over the last 14 to 15 years. So that's a good place to be. They're pretty safe from that perspective, just a general asset allocation. Bonds should have a lot less risk, and they're generating better returns than we've seen for a while. Equities have more risk, and they've gotten more expensive. I would temper my expectations for what equities will do going forward, and make sure that I'm diversified. That diversification in a portfolio means, from a car dealer perspective, what I would say is I'm not only selling just trucks, right? Or I'm not only selling, many of your dealers, I'm sure, have multiple brands, right? It's being diversified, because if I hang everything, all my economics on one brand or one model, what happens if gas prices go up? I know. Right. Don't time me with the auto market. I bought my truck, I waitlisted, and then right when gas went in California over $6 a gallon, that's when I got my big 4-wheel drive. So I'm not good at timing things, but you all know, and you've been through those ebbs and flows when EVs are really attractive and then they're not so attractive. When SUVs are in demand. So when you think about modern portfolio theory, you want to combine things that move differently. And if rates are flat, bonds should be okay. If rates go up, not so great for bonds or stocks. If rates go down, great for bonds and maybe good for stocks.
Good. Well, look, that's all great information. And like I said, timeliness of our conversation and this sort of conversation, I thought would be great to share with our folks. I also want to make mention that like myself, Todd is also a former active duty Marine. And typically we try and talk in small words and use pictures, but Todd is blowing that narrative up and really, I think, has given us some great insight and information here, Todd. Before we wrap up, any final words or anything else you'd like to add? I mean, we went into some good depth and at a high level with the various items we spoke of, but any parting words before we sign off today?
What I'm excited by is artificial intelligence. That's kind of amorphous. What does that really mean? I think if you think about what happened to our economy when we introduced cell phones, internet, the personal computer, we're very conservatively believing that can add, the AI, 0.4% to our GDP growth, gross domestic product growth. If you think about GDP growth around 2-ish% as the norm, this year we're going to be above. We think we're closer to 3. Next year slowing some because we pulled some growth forward. But artificial intelligence will allow us to do a lot of things quickly. As we look at different offerings, say bond offerings, there can be thousands of them you have to go through. That's really hard if you have to go through 1,000 bond offerings to find the 1, 2, 10 that you want to buy. We use machine learning. That's artificial intelligence. I when I tell people I was visiting, I was just came back from New York, and my family asked me how was it, and I said, I don't really know, because I land, my face is in my phone, I'm answering advisors and client questions. I get in the Uber, same thing. I get to my hotel, I kind of look around, where am I? I go in, I'm always on my phone. That's increased productivity. Whereas in the past, you print up a stack of papers, you take your yellow highlighter, and we've become very efficient, and we're looking for that as a way to keep down our debt to GDP as a nation. So I think we have high hopes for what artificial intelligence can do and how it can make us a more productive economy and keep down that debt to GDP. As long as you have the growth high, that's a good thing. If you're spending like we are, if the growth slows and you're still spending where you were, like you were making a lot more money or bringing a lot more tax receipts, that's not a good thing. So artificial intelligence is what we'll be really watching.
Yeah, it's a great point because, as you would imagine, automotive, that's a hot button issue for sure. We're already seeing various iterations of AI taking hold in our industry as we speak, and that's something we're all going to be watching as well. And it's hard, I think, when you talk about predicting the growth of that, like you mentioned, the cell phones a lot, but with AI, who knows how fast that could really become a huge impact on the overall aspects of our economy, our day-to-day business dealings, and everything else. It feels like we are in the baby stages, but with all things AI, because it can grow so quickly and so expansively, to me, that's a great one to keep an eye on, and frankly, it's a little bit hard to predict because of those things.
Yeah, now I'm not recommending Amazon as a stock, but just take a look at what their recent announcements of what they are attributing to the cost savings due to AI.
Yeah.
I think I'd be hard pressed to find anyone listening to the podcast that doesn't order off of Amazon, especially if you had someone that was just, there's no way I'll ever use the internet or go, once you hit the pandemic, even those stubborn, consumers started using,
my mother
online
still
shopping.
will not. That's the exception. My mother is in her 80s, refuses to, will not. She's the last holdout that I know of. But I think you're right.
Yeah.
Especially this time of year, we're seeing it. Everyone's on Amazon trying to get those gifts and things in here in time for Christmas.
Yeah, I haven't been to a Black Friday for about 10 years.
That's
After
right.
waiting around, the line was looped around Target twice to get the Beats headphones for my son, who then returned them a week after Christmas. Never again. And everything, I just wait for all my packages to show up. So
yeah, I feel like we're better off without the Black Friday 4:30 in the morning lines and everything else. Boy,
I
seems like a long
was
time
sound
ago.
asleep on Friday at 4:30 a.m. this year.
There you go. Well, look, hey Todd, thanks so much for joining us. Again, this is Todd Buechs. He's a investment advisor here at Bernstein Wealth Management, and again, KADA works closely with Bernstein, and we'll have a bit of information regarding that when this podcast goes out. But for those of you who have joined us on this edition of Kentucky Horsepower, we appreciate your time, and we'll see you down the road.